There's a mistake a lot of people make when they look at silver, and it's not a technical one. It's a mindset problem. They treat it like a trade that exists only on a screen, something that behaves like every other risk asset they've watched over the years, something that rises too fast, attracts attention, and then obligingly collapses to reward anyone bold enough to fade it. That assumption works in markets where supply can be created, liquidity can be injected, and settlement is mostly theoretical. Silver is not one of those markets. What's happening now isn't about excitement, it's about pressure. And pressure in a physical market builds quietly, long before it becomes obvious to people who only look at price. The danger is not that silver has moved higher. The danger is that a growing number of participants are being encouraged to fight the move without understanding what's actually tightening underneath it. Silver sits at an uncomfortable intersection. It's financial enough to trade aggressively, but physical enough to break systems when leverage outruns reality. When those two sides drift too far apart, the market doesn't resolve politely. It resolves through stress, through forced decisions, through mechanisms that punish confidence more than ignorance. One of the clearest examples of this is how margin requirements behave when a market stops acting normally. People love to say exchanges raise margins to cool things down, as if that's the whole story. But exchanges don't exist to manage price. They exist to make sure trades settle. Their real fear isn't volatility. It's failure. Failure of collateral, failure of delivery, failure of confidence in the clearing process itself. When prices rise in a leveraged market, and especially when they rise alongside signs of physical tightness, margin becomes less of a rule and more of a constraint. If margin scales with notional exposure, then every incremental price increase forces leveraged positions to commit more capital just to stay alive. That's not a one-time event. It compounds. And for shorts, that compounding pressure works in the worst possible direction. This is why vertical moves in silver right now shouldn't be viewed as excitement or mania. They're stress events. Each one asks the same question: who can afford to stay in this trade if conditions don't improve quickly? And each time the answer is fewer participants than before. The mistake is assuming that once price pulls back, the pressure disappears. It doesn't. It migrates. Some positions close, others weaken. The system resets slightly tighter than it was before. That's how squeezes mature. Not through nonstop rallies, but through cycles that quietly drain resilience. Deliverable supply is where this becomes real. Warehouse totals look comforting until you separate what exists from what can actually be used to settle contracts. Eligible metal is not the same as registered metal. Only a fraction of reported inventory is truly available at the moment it's needed. When that fraction shrinks, while paper exposure remains large, the system becomes brittle. In normal times, that brittleness doesn't matter because most contracts never ask for metal. They roll, offset, or cash settle. But when a higher percentage of participants start acting like delivery matters, everything changes. Promises start competing with reality, and reality doesn't negotiate. Industrial buyers understand this instinctively. They don't care whether a chart looks overextended. They care about continuity. They care about inventory buffers. They care about whether delays force them to slow production or miss commitments. When those risks rise, behavior changes fast. Buyers pull forward demand, accept higher prices, and prioritize access over cost optimization. That behavior doesn't show up cleanly in sentiment surveys. It shows up in delivery patterns and regional premiums, in how quickly metal disappears when it becomes available. Those are not speculative signals, they're defensive ones. Global supply chains make this even more sensitive. Silver demand today isn't driven by novelty. It's driven by systems that are expanding structurally: energy infrastructure, electrification, data movement, high reliability electronics. Even as manufacturers reduce silver intensity per unit, overall demand can rise because total output grows faster than efficiency gains. Supply doesn't respond the same way. Much of silver production is incidental, tied to mining other metals. That means higher prices don't automatically unlock new flow. Mines can't pivot overnight. Refining capacity can't be expanded on demand. Permits, capital, and logistics impose real delays. Processing concentration adds another layer of fragility. When refining and fabrication capacity sits in specific regions, policy changes, export controls, or even bureaucratic friction can tighten supply without any dramatic announcement. In a just-in-time world, friction equals shortage. And shortages don't need to be absolute to be disruptive. They only need to be inconvenient at scale. This is why narratives blaming retail enthusiasm miss the point. They simplify something that's fundamentally mechanical. Heavy volume without corresponding open interest growth often signals hedging and repositioning, not fresh speculative conviction. Persistent premiums signal access problems, not excitement. Those footprints matter more than headlines. Shorting into that environment because something feels too high ignores how asymmetric the risk becomes when physical constraints are involved. Losses aren't governed by valuation logic. They're governed by collateral requirements, liquidity availability, and the willingness of counterparties to absorb pressure. When those variables tighten together, exits become expensive quickly. This doesn't mean price can't correct. It can and it will. Volatility is part of how the market transfers risk from those who can't tolerate uncertainty to those who can. Pullbacks don't disprove a thesis in a constrained market. Often they reinforce it by shaking out weak positioning. The real question isn't where silver trades next week. It's whether the system has enough slack to absorb ongoing physical demand without forcing increasingly aggressive adjustments in leverage and settlement. When inventories are thin, the margin for error shrinks. Small surprises become large moves. Before engaging, it's worth being honest about intent. Are you trying to exploit short-term volatility, or are you positioning around a structural condition that may persist longer than comfort allows? Those approaches require different sizing, different expectations, and different emotional discipline. Markets like this don't reward bravado, they reward solvency. Understanding that difference doesn't guarantee success, but ignoring it almost guarantees regret. Another place where people get themselves into trouble is by confusing motion with resolution. They see violent price swings and assume the market is deciding something definitive, when in reality it's often just reallocating stress. In systems where physical constraints matter, volatility is not a verdict, it's a process. It's how the market tests who can remain solvent, who can tolerate uncertainty, and who is forced to act before they're ready. This is especially true when derivatives activity is heavy. Options-driven flow can temporarily dominate price behavior, pushing the underlying in ways that feel exaggerated and unstable. Dealers hedge dynamically. Exposure flips quickly. Volume spikes and collapses. To an untrained eye, it looks like chaos. To the market, it's plumbing doing what plumbing does. The mistake is assuming that, once that mechanical pressure fades, the underlying imbalance disappears with it. Most of the time, it doesn't. In fact, some of the sharpest moves tend to happen after these artificial pressures roll off. When short-dated options expire, the hedging flows tied to them vanish, and the price is left to respond to more durable forces. If physical buyers are still active, if inventories are still tight, the market can reprice abruptly, not because sentiment changed, but because the temporary weights were removed. This is where many shorts find themselves trapped. They interpret every dip as confirmation, every pause as exhaustion. They re-enter with confidence, assuming the pattern must repeat. But repetition requires identical conditions. And that's the part most people skip. They remember the shape of past moves but ignore the structure underneath them. Structure matters more than memory. Today's silver market is shaped by a combination of constrained supply, inelastic demand, and a derivatives ecosystem that amplifies stress rather than smoothing it. Those ingredients don't produce tidy outcomes. They produce uneven ones. Sharp rallies, sudden pullbacks, long consolidations, and then moves that feel disproportionate to the catalyst. Another misconception is that large institutions are somehow immune to these dynamics. They aren't. Institutions are made of humans, incentives, and risk frameworks. When the dominant narrative in the room says a move is driven by excess or speculation, it creates comfort around opposing it. That comfort can persist right up until it evaporates. Crowded positioning doesn't announce itself. It reveals itself only when exits become scarce. What makes this particularly dangerous in a physical market is that the exit door isn't just price dependent, it's collateral dependent. If margin requirements adjust as prices rise, leveraged positions face a compounding burden. They must add capital at the worst possible time, when losses are already mounting and volatility is high. That's not a theoretical risk, it's a mechanical one. For buyers who actually need silver, none of this is abstract. Their concern isn't where price settles at the end of the quarter, it's whether they can secure material reliably. In that context, price becomes secondary to availability. Paying more is preferable to not having supply. That priority changes how markets clear. It introduces a form of demand that doesn't disappear just because the chart looks uncomfortable. This is why regional price differences and persistent premiums deserve attention. In a healthy, well-supplied market, arbitrage closes gaps quickly. When gaps persist, it's a signal that metal can't move freely to where it's needed. Access becomes valuable in its own right. And when access matters, paper representations lose some of their authority. It's also why dismissing inventory drawdowns as temporary noise can be risky. Inventories are the buffer that absorbs shocks. When buffers shrink, the system becomes more reactive. Small disruptions have larger effects. A delayed shipment, a maintenance issue at a refinery, a policy adjustment, any of these can tip balance temporarily and force price to do the rationing work. Rationing is uncomfortable because it's nonlinear. Price doesn't rise smoothly. It jumps, pauses, overshoots, retreats, and then repeats. Those movements frustrate participants who expect symmetry and punish those who confuse volatility with reversal. At some point, something has to give. Either demand eases materially, supply expands meaningfully, substitution reduces reliance, or policy intervenes. None of those outcomes are immediate. None are guaranteed to restore prior conditions, and all involve trade-offs that markets often underestimate. Until one of those forces dominates, the environment remains fragile. Fragile environments don't reward overconfidence. They reward preparation. That doesn't mean predicting exact levels or timing perfect entries. It means understanding the range of outcomes and positioning in a way that doesn't require being right immediately. This is where personal intent becomes critical. If you're approaching silver as a vehicle for fast gains, you're likely to be pulled into emotional decisions, chasing moves, fading strength, reacting to noise. If you're approaching it as exposure to a structural imbalance, your focus shifts. You think in terms of allocation, liquidity, and resilience. You respect volatility rather than trying to conquer it. Neither approach is morally superior, but mixing them is dangerous. Trading a structural squeeze like a short-term momentum play often leads to decisions that don't align with the underlying reality of the market. There's also a psychological trap worth naming. When people feel late, they often seek revenge on the chart. They short not because their analysis is strong, but because they want the market to validate their discomfort. That impulse is human. It's also expensive. Markets don't exist to resolve feelings. They exist to allocate resources. In environments shaped by physical constraint, humility is not optional. It's a survival trait. Recognizing that you don't control outcomes doesn't mean opting out. It means engaging with respect for forces that don't bend to opinion. If there's a single lens that clarifies this moment, it's the difference between price risk and availability risk. Price risk affects portfolios. Availability risk affects operations. Companies can hedge one more easily than the other. When availability becomes the dominant concern, behavior shifts in ways that charts alone can't explain. That's why the most important question right now isn't whether silver is overbought or due for a pullback. It's whether the system has enough slack to meet real-world demand without forcing increasingly aggressive adjustments. As that slack diminishes, the character of the market changes. Understanding that doesn't make outcomes predictable, but it does make them intelligible. And in markets where intelligibility is scarce, that alone is an edge.